Hello, everybody. Welcome to Tuesday. The S&P 500 was down 2% today, really kicked off by Walmart and Home Depot's earnings reports today. The reports weren't bad at all, just the forward guidance. It was kind of scaring the market. The market's already been in a downward move. We had some triggers, and we made moves last Monday based on those triggers from the Friday prior. So once the market kind of gets in a downward motion, the same information can be presented, in an upward market and it's kind of ignored. But in a downward market like this, it tends to kind of really react. On some talk about the potential for slowing, higher costs for labor, those types of things, which will potentially eat into some of the margins for some of these companies as far as that goes. So, we'll have to see how that plays out so far. It's kind of interesting. It's basically like most of the companies are saying we're okay right now. We did quite well, in the fourth quarter. We're a little bit worried about what we see on the horizon, and so that's been in a nutshell, kind of the earnings season as far as that goes. Makes some sense. We have higher interest rates and those types of things. We were looking at maybe one more rate increase. Now the expectation is two rate increases. Starting to hear, rumblings for 3 1/4 point increases that might end in May. So we'll see how this plays out. The economy is still kind of moving along really well. And again, you're looking at a bunch of companies and their CFOs and CEOs making projections about what they see coming. They also have somewhat of a vested interest to kind of lower the bar for the future so that the analysts ratchet down their expectations for earnings, makes it easier for them to jump through those hoops and maybe surprise to the upside, which a lot of these companies really like to do. So good time to be kind of defensive. Again, we moved into utilities. We've got, high dividend paying stocks, got some energy pieces. Energy didn't do that great last week, but did quite well today compared to the market. We had the international, especially developed market internationals in our taxable account that we have going that did better than the market today too. And the bond pieces that we had really did well last week and continue to do well today. Matter of fact, our most aggressive inverse bond portion was up 2% today. So again, not everybody has all of these different things. Depends on whether you have a higher risk or lower risk model, and whether you're in taxable or tax deferred, those types of things. But just trying to give you a general overall feel, that we did get some signals, and it has worked out to be pretty accurate so far. The market has come down. Now, the market keeps coming down. Maybe you want to get even more defensive, start to use some more T-bill things and things like that. But generally speaking, you want to stay in the stock market, maybe get more defensive in that stock market, because if we do get a bounce at some point, you want to be in on that bounce. You can lose an awful lot on that. Even that first day of that bounce can be quite dramatic. And so you kind of have something in there that captures at least some of that upside versus a T-bill, for example, which really doesn't. So we'll see how this plays out, but look forward to seeing what's going to happen tomorrow. Thank you very much.